This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Taylor from Life Goal Investments. How you doing, buddy?
Oh, I'm doing great as always. Thanks so much for having me.
Absolutely. So we got to start off with CPI, right? We talked about it last week. You have a great playlist on this channel that people can go back and watch. But we got CPI. Headline came in. If you're Kathy Wood, you can actually say it came in lower, and we have peak
Glass half
inflation.
full, half empty, however you look at that.
Yeah. But then if you flip the glass over, and you could say core inflation's going up, right? 6.6 instead of 6.3. So what did you see in all of that? I think you were surprised. I think you were hoping for something in the high sevens,
Yeah.
maybe 8 flat. But what'd you see in the reading?
Yeah, it was interesting. I mean, it just shows that this is just a persistent animal that we're facing right now, and it's going from one thing to the other. What's driving the inflation is moving around, and what we saw in the headline number is food prices are just bananas right now. And if anyone's going to the grocery store, they're not surprised, but that's what's driving. Food prices are up 13% year over year. That's massive, and that obviously hits the people that can afford it the least, really, which is the scariest part of the whole thing.
Yeah. Yeah, and unfortunately, I think we've seen maximum benefit from the release of the strategic petroleum reserves. I think we've obviously entered the fall with winter being right behind it. I'm particularly nervous that headline can go back up, right? 8.1 will be at least the cycle bottom, and next month might be higher. Do you have any thoughts on that?
Yeah, I concur with that, unfortunately. And this was we both kind of alluded to this a little bit last week, where you saw energy prices coming down, but then oil popped again. OPEC came in and said, we're taking 2 million barrels off the market. And that obviously drove them back up. And there's just still now mounting further. It's crazy to say that geopolitical risk is getting worse, but it really is. I mean, there is a war playing out, and we all know that, between the Ukraine and Russia, but now there's bigger things that are entering the picture there, and how crazy can it get over there, and how much does it spill over to the rest of the planet? And that's really, the biggest scare that's driving oil prices, I think, in a major way right now. But it's funny, you mentioned the difference between headline, which came in at 8.1, 8.2, what was it? 8.1, I think.
No, 8.2.
8.2. Okay. So there you go. So it came down a little bit from the prior month, but core was the worst we've seen. Core was the worst we've seen. And you hit the nail on the head there. And it's just incredible how much driving force there is behind the housing market, and how that doesn't change quickly. And it's not going to change quickly. We know that the rent is a massive, massive component of that inflationary number. And, the housing component, the shelter component of core, makes up about 40% of it. So if you don't get a rollover in housing prices, which you're likely not going to see anytime real soon, there can't be a massive downtick in that core number.
Yeah, there's really two things. And I was jumping up and down about core starting last month, because I think people were missing. Everybody was talking about headline. So rent and rent equivalent, all that. But the other one that's coming through, and this is where Kathy Wood and Mark Zandi and all these people talking about, there are people talking about inflation being cut in half in 6 months.
Not going to happen. Not going to happen. Not going to happen.
That's a bold call.
I don't know how you can tell, and I've been a little bit at fault of this myself, and you can bang on me a little bit on this. Like, I've been saying that inflation is going to come down quicker, but when it persists as long as it has, it shows that this isn't just a plateau that it falls back off. When things remain for this long period of time, it's not like it's just going to roll over on itself.
Yeah.
And you have to adjust. Again, they're selling their book. That's what they're doing. Kathy Wood is, for the reader or for the listener's context, Kathy Wood has the ultimate growth fund. What growth funds have are a ton of interest rate sensitivity. So she is saying that inflation is going to come down, driving down rates, causing the stocks in her portfolio to pop. That's not going to happen.
Yeah, no, absolutely. And
one more note on that, if I don't.
Yeah, please.
She has seen net inflows. So how much money has come in, and then subtract out how much has gone out. She's seen net inflows in the top 3% of all ETFs for the entire year. It's somewhere over $1 billion of net inflows.
People are still giving her money.
People are still giving her money hand over fist, because obviously she's seeing massive outflows too, because some people are going, hey, I'm going to sell this for the tax loss. But other people are right there in line going, hey, I'll buy it from you because I think there's going to be a massive resurgence out of the other end of this. Clearly, otherwise you wouldn't buy it. Unless you think there's a massive upside room for this to go, you wouldn't buy it because there is a ton of inherent risk in this thing.
Well, I think she's having a pretty good day today. I think Roblex is one of her largest holdings. I think it popped 20% today. So, hey, yeah, buying at the bottom, maybe. Yeah, it's not a bet I would make. But
Yeah,
again,
we hit a
I don't
52-week low last week, but
Woohoo!
we don't need to belabor that point.
No.
Anyway.
Yeah, so back to Mark Zandi, because he is also calling, and I think talking his book. He's really a real estate guy. He came out and said inflation was going to get cut in half, and I just don't see it. Right? Obviously, the rent stuff's coming through. The big one again, where I jumped up and down on core last month, was what's reported as services, but in reality is wages. And I think wage inflation has just started. Now, some people don't really get the fact that how can we have wage inflation if we're in a recession? I'm like, you're not paying attention because it's happening right now.
Right.
So yeah, talk about that.
It's a confusing economy in general right now, because what you see is whether we are or are not in a recession at this current juncture, you generally do not have the Federal Reserve raising rates, making debt more expensive in a massive slowdown. You know, it's unarguable that we're seeing a massive slowdown in the economy right now. Whether it's outright a recession or not, that's up for debate. But you generally don't see a tightening policy when everybody knows that things are slowing down. And so it's a really weird economy right now. Generally, what you see is the Fed raising rates when things are still go gangbuster, the economy is growing and things are moving in the right direction. Now, obviously, the really scary part of this whole thing is we're seeing a massive slowdown in the economy. And there's no arguing that the data is absolutely slowing down. And it's not just domestically, it's around the world. And around the world, our Federal Reserve being our central bank, but other central banks around the world are also tightening policy. So you're tightening into a very, very sticky situation right now because you have this massive slowdown in the economy.
Yeah. So at the end of the day, I think this CPI print really makes a fourth 75 basis point rate hike a lock. I think 50 is out the window. I don't even think that's betting anymore. What is the current number on 100 basis? Because I think that's got what 10, 12, 14% chances of 100 basis.
Yeah, that's right about right. Yeah, I think it's about 14% right now as of earlier today. So yeah, they're going from it was a chance of 50 and you know, and 75 still more likely than 50 to that 50 rolled right over the 75 in the other direction on the triple digits. So yeah, it's no CPI. It came in hot, and the core portion of it, which is the stickier portion of it, which is why that's what the Fed looks at, came in the hottest we've seen since '82. So it was not a pretty picture last week on Thursday. And it was funny how the market reacted, right? So the market came out up. Yeah, the market went down. So you take the S&P as the proxy. The S&P was off 2.4% right out of the gates in the morning. And at about 9:40, 10 Eastern time, 10 minutes into trading, it started to revert back up. It ended up over 2.5% that day. And this goes to say, like, you know, obviously timing the market doesn't work, but it also goes to show you that, like, when you look back throughout history, and I'm not saying that was a bottom. That's not what I'm getting at all. But bottoms don't always happen for a particular reason. There was nothing in 2009 that you could go, that's what drove the bottom on March 9th of 2009. That's where it was. Things at some point do just get the overly negative, overly sold, and there doesn't have to be that big catalyst to drive them back up. It's just at some point, the buyers start to come back in and say, this is so darn cheap. And then the algorithms start to buy back, et cetera, and drive things back up.
I was going to ask you about that. We'll do it in another video, but we'll do it right here. So what I saw, and again, I'm not in the market. I'm some guy that has got like $2,000 in the market or something stupid. I saw the market hit 3,500 on the S&P 500. I think that was a number that everybody and their brother, I think it was a Fibonacci level for all those freaking technical traders. I think that forced buyers come in, but it wasn't really buyers per se. It was people who were playing the downside. So they had puts. And they wanted to recognize their profit. And then once that reverted, it just, the algorithms took over and it was machine driven. Any truth to any of that, or am I overthinking?
Yeah, I think that's a fair statement. I think it's a combination of a few things, but a lot of times what you have is short positions. So big hedge funds and things like that are betting on stocks to go down. So when they bet on stocks to go down, they essentially have an inverse ownership. So they don't own them. They're trying to force them down. So when the market gets really nasty on the downside, they go, okay, either I'm going to cover this position, forcing them into a buy, and that, you know, has this reverberating cycle of forcing the market back up. And that's a lot of what you see in short order. And then what happens is in very short order, machines start to purchase along with it. because it
Yes.
starts to hit different ticking, essentially a domino point. The
Levels,
machine will
yeah.
go, okay, if this hits $100, we'll buy it. Bang, that domino goes down. And then it goes to 101 and bang, 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 bang. And that's why you can get such a violent movement upwards. And a lot of that is driven in this kind of technology era that we're in now, which is also why you can see more volatility in the market in short order than you could in the past.
Oh, absolutely. Well, do me a favor. You put out a lot of great stuff on your Instagram feed. Tell people what it is and we'll get into round 2.
Yeah, thanks so much. So it's at Life Goal Investments, and we put out stuff there daily on kind of macroeconomic market type things, just trying to make it simple for everyone.
Oh, you do an amazing job. It's very well done.
Thanks,
bud.
man. Appreciate that.